get more on this, John, because I want to bring in somebody from our chief economist, Mark Zandi, who's from Moody's Analytics, has been talking quite a bit about the downgrade and also the potential for the downgrade. Erik, of course, standing by as well, joining me on this. Mark, you know, a lot of people are now wondering, look, you've got S&P that made this downgrade. When are Moody's and when are Fitch, you know, when are they going to make their move? Are they, do you believe?
Well, let me just point out that I'm not part of the rating agency, Betty. I'm part of Moody's Analytics, a separate subsidiary,
right,
so I don't have any direct input in. Yeah. Well, I think if policymakers continue to follow through on the debt ceiling deal, then I don't think there will be a downgrade. And in fact, I think the deal was a substantive one. It didn't get us to fiscal sustainability, that $4 trillion in 10-year deficit reduction, but it got us more than halfway there, and I think it was a good step forward. Now, policymakers need to do more. I think we need to generate more tax revenue. But I think there's a narrative to do that late next year in the lead up to the expiration of the Bush tax cut. So I think there's a very clear path at this point to achieving that goal of fiscal sustainability. So if policymakers do that, and I have every confidence that they will, then I don't see why the U.S. should lose its AAA rating.
Mark, to what degree...
Mark, does that mean that... Go ahead, Erik.
Mark, I was just going to ask you, to what degree does a downgrade like the one that we saw from S&P incrementally contribute to the lack of confidence in the U.S. economy right now?
Well, it does. It certainly hurts confidence, particularly now, given that confidence is so weak for lots of other reasons. The U.S. economy is soft. The European debt crisis is in full swing. So this really does hurt. But my sense is that we can overcome this because the fundamentals aren't that bad. In fact, you know, we've got our problems, but the fundamentals are moving in the right direction. And as that becomes more evident, I think that'll win the day and confidence will improve. But clearly, this is a blow to confidence, and it hurts.
Mark, it may be too early to think about this, but I'm going to ask you anyway. What would it take for the United States to win back the AAA rating?
All I think policymakers need to do is follow through on the spending cuts that they announced with the debt ceiling deal. The Commission come forward with a script towards the spending cuts. And then late in 2012, as we lead up to the expiration of the Bush tax cuts, come forward with a tax plan, hopefully some tax reform, but at the very least, raise a bit of tax revenue, and I think we're golden. We've achieved our goal. We've hit the target that both Republicans, Democrats, the Fiscal Commission have all agreed is our target, and I don't see any reason at that point why there should be any question about our AAA rating.
And Mark, just finally, I mean, is this going to tip us into a recession?
No, I don't think so. You know, I think that obviously it's very close. The economy was already very fragile before the downgrade and the impact this is having on financial markets. But, you know, I think the most fundamental reason for optimism is that American businesses are in very good financial shape. Their profit margins are about as wide as they've ever been. They're generating a lot of earnings growth. It's really not a question of can they go out and invest and hire more, which is the key to continued recovery. It's a question of willingness. It's a question of confidence. So if we can get by this crisis of confidence, and I think we will, then I think we'll be in good shape and the recovery will gain traction.
Mark, thanks for joining us here on this special edition of In the Loop.